Hi friends, today we would do basics of derivatives. So derivatives is mentioned in the finance part as in general topics of finance, and we have to do basics of derivatives and not details, right? So let's see what would we cover in this video. So agenda of this video would be we would understand what are derivatives, why do we use them, and then we would understand few of the derivatives which are very popular. So we would talk about forwards, futures, options and swaps. So these are also mentioned in the syllabus for our exam, and then we would skip this derivative markets in India because this is not mentioned in our syllabus. So what are derivatives? Let us understand derivatives by taking an example. So for example, I have a restaurant and I want to hedge my risks for buying the vegetables. What should I do? So I want to hedge my risks. So just keep track of these new words. Hedge means I want to keep my risk to the lowest level, right? So what should I do? Generally what happens in restaurant industry is you sign a long-term contract, a year-long contract with your vegetable vendors for buying tomatoes at a fixed price. So here the fixed price is rupees 20 throughout the year, right? So you also mention the quantity, right? So for example, you would say that I would buy tomatoes from you throughout the years at rupees 20 per kg, and the upper cap for buying the tomatoes would be, let's say, 100 kgs per day. So that I would define in the contract. So what happens now? Now the following scenarios could happen. Tomatoes cost 10 rupees 10 in the market. In this case I am losing rupees 10 per kg, right? So this is one case which would happen, right? Tomatoes are selling at rupees 10 per kg, but I have already done a contract that I would buy them at 20 rupees per kg, right? And hence I am losing rupees 10 per kg. The second would be tomatoes cost rupees 40 per kg. Now I am better off. In this case I am saving rupees 20 per kg, right? The third scenario which is not mentioned here is tomatoes are sold at rupees 20 per kg, and in that case I am not at profit, neither am I at loss, right? So why am I doing it? The important question is why am I doing it? So while selling the final good, right, which is my dishes in restaurant, I have a fixed price, right? I would sell a, let's say, dal at rupees 300 per plate, right? I want to assure that the input cost is also the same, right? But I know that input fluctuates a lot, right? Vegetables fluctuates a lot, and I want to hedge that risk, so I enter a contract with a vegetable vendor. So what am I doing? I am hedging my risks. So keep track of this term, hedging my risks, right? And what is this contract? This is a simple form of derivative between two parties, right? So derivative is what? Derivative is nothing but an instrument which derives its value from an underlying asset, right? So this contract is called derivative, and it derives the value from the underlying asset. And what is underlying asset here? Underlying asset here is tomatoes, right? Now let's imagine further that due to rainfall, the speculation that there is a speculation that tomatoes would cost rupees 80 per kg, right? So I am very happy that I would be saving rupees 60 per kg, right? Now imagine I want to shut down my restaurant, right? What should I do with this contract? There is another restaurant which wants to buy my contract by paying me rupees 2 lakh, right? So there is another restaurant which says ki you are shutting down your restaurant, let me buy this contract from you and I'll pay you rupees 2 lakhs. So I would transfer the rights of my contract to this new restaurant if that is possible, if that is written in my agreement, right? So I'll make profit right away. Thus this contract now becomes an instrument to trade, and hence it is called a tradable derivative. So it is tradable derivative. So we are not giving terms to these derivatives, but you would see that the first one was a simple forward contract, right? And this one, if there are certain terms and standardizations in the contract, is simple future contract. So now let's define derivative. A derivative is a security, right? So it's a piece of security or a contract with a price that is dependent upon or derived from one or more underlying assets, right? So in our previous example, the underlying assets was tomato. So the value of derivative was based on the price of tomatoes. So underlying assets can be securities, which can be stocks, commodities like tomatoes or wheat or oil, weather, so there are derivatives on weather as well. There could be bullion, which could be gold, silver and all that stuff, right? There can be derivatives on bonds, currencies, interest rates, index markets. So there can be derivatives on anything, right? If you want to do a contract and there is an underlying asset, then there could be derivatives. So for example, in IPL auction, people are selling the players, so there could be derivatives on selling of these players as well, right? So there could be derivatives on anything. So why do they exist? You see that I want to hedge my risks, so that's why I bought the derivatives. The tomato seller also wants to hedge his risk. He knows that the price of tomato could go at as low as ₹5 and he would be losing money, right? So he wants to hedge his risk. He says that let me sell them at 20 throughout the year, right, and earn some fixed profit rather than just being in limbo that whether I would earn profit or I would earn loss, right? Then there could be people who would buy it for speculations or placing bets, right? So they would buy derivatives. If they are bullish, they would buy the derivatives thinking that the market would pick up and they would earn profit. If they are bearish, they would buy them thinking that the market would go down and they would make money. Then the derivatives could be bought for diversification, right? So you have a portfolio and you want to diversify the portfolio. For example, you trade in commodity, but now you want to trade in stocks as well, but you have limited wealth. The best way out to still trade in stocks would be derivatives, because you can have a lot of exposure. That exposure is called leverage with little money. Leverage, right? With little money through derivatives, right? We would see how when we discuss future contracts. Then the last one could be arbitrage. So arbitrage is nothing but you want to take price advantage in one market with respect to another market, right? For example, there are chilies which are selling in, let's say, Hyderabad at ₹20 per kg, and then there are chilies which are selling in Delhi at ₹40 per kg. So the price difference is arbitrage. So you could buy derivatives in Delhi as well as in Hyderabad and use them as a tool to manage your risks and earn profit. So these are 4 basic uses of derivatives. The essential, most well defined and most logical use is to hedge the risks, right? So big companies try to use derivatives to hedge their risks. So to hedge the risk is the most important function of derivatives. Now let us look at various type of derivatives, which is important from our exam point of view. So we'll look at forward contracts. So the one which we have seen before, the tomatoes and the restaurateur contract, is a forward contract. So it's a customized contract between two parties. So customized is important here. So it's not standardized, it's customized contract between two parties to buy or sell an asset on a specific price on a future date. So on a specific price, the price is specified in the contract, and on a future date, the future date is mentioned, and as well as the quantity is mentioned, right? So these are the 3 things which are mentioned in the contract. So again, a forward contract can be used for hedging or speculation, although it is non-standardized. So keep track of these words. Non-standardized nature make it particularly apt for hedging. A forward contract settlement can occur in cash or on delivery basis, right? So for example, in our previous example, if tomatoes price go up to 40 rupees per kg, my vendor would say I cannot give you tomatoes, but I would give you rupees 20, right? Rupees 20, which is required to buy tomatoes from market at rupees 40, right? So he would settle in cash, or he can deliver the tomatoes on physical basis. Forward contracts do not trade on centralized exchange, right? So they are not traded on centralized exchange, and they are regarded as OTC, over the counter instruments. The lack of centralized clearing house also give rise to high degree of risk. So there is a default risk. For example, the price increases and my vendor would say, I am not going to value the contract, I am not going to give you the tomatoes, nor am I going to give you the cash, right? So I cannot go do anything. There could be a legal action, but it would take its own sweet time, right? So they are not centrally managed. There is no clearing house as such, right? Our example of tomatoes we said, right? So here we have mentioned that there would be 1000 or 1 lakh kgs of tomatoes at 10 after 6 months. So this price is called forward price, right? So this is forward price. So now imagine that after 6 months, when he is going to deliver the tomatoes, there would be a price which can be this price, or which can be different from this price. That price would be called spot price, right? So two terms which you have to keep in mind is spot price and forward price, right? In case of forwards we call it forward price. In case of future we call it a future price, right? So we can even call it a future price here as well. So this is a future price which is decided beforehand, right? The spot price is price of that day. So again, the scenarios is the same. We have done it before. The settlement can happen in cash, or they have to be in physical delivery. So the person who is, if I am buying the contract, I would say that I am holding a long position, right? I am holding a long forward, and the person who is selling the contract, we would say that he is shorting the contract, or he is holding a short position, right? So these are the two terms which you would see in all the derivative instruments, long and short. Long means that I have right to buy it, I am the buyer. Short means I am the seller, right? As simple as that. So S for short, S for seller, right? Now let's go to another one, which is future contract. Almost similar to our forward contract. The only difference is that a contractual agreement generally made on trading floor. So it's made on trading floor of a future exchange to buy and sell a particular commodity or financial instrument at a predetermined price in future. Again the same thing. Only difference is trading floor of a future exchange, right? Terms and conditions are highly standardized, right? So for example, if you want to buy stocks, the terms and conditions would be specified, right? So you would be able to buy stocks in lots, right? So number of shares in each lots would be fixed, right? For example, if you want to buy Infosys stock, you have to buy in lots, right? And let's say one lot is equivalent to 300 share, so you have to buy 300 shares, right? Or you have to buy a future for these 300 shares. So imagine your risk increases. So if there is, let's say, rupee 1 differential or change of rupees 1 in Infosys stock, you would be making loss or profit of rupees 300, right? So that's the risk nature of future contract. Trading takes place on formal exchange, wherein exchange provides a place to engage in these transactions and set a mechanism for the parties to trade these contracts. So in India, NSE does that. So there is a trading on NSE, right? You trade derivatives on NSE. There is no default risk because the exchange acts as a counterparty, guaranteeing delivery and payment of use of clearinghouse. So obviously when there is an exchange, there is a brokerage or there is a fees which this exchange would charge. It would act as a counterparty, and so there is no counterparty risk as such. In few forwards there was a counterparty risk, right? The counterparty is another party, right? It's simply, for example, if I am a restaurateur, so for the tomato vendor for me would be a counterparty, so I have a counterparty risk. The clearinghouse protects itself from default by requiring its counterparties, so both the counterparties, the buyers and sellers, to settle gain and loss or mark to market. So this is also important, mark to market their positions on daily basis. So for example, in our example of tomatoes, right, we enter a contract for, let's say, 1 month, right, and we say that rupees 20 is the future price on which we are going to settle, right? Now today let us say the price is rupees 21, right? So the daily settlement would happen between me and the vendor, and he would give or deposit rupees 1 in my account, rupees 1 per kg in my account. So if our contract is for 10 lakh tomatoes, so he would deposit 10 lakh in my account on daily basis. Now on day 2, let's say the price decreases and it becomes rupees 19, right? In that case I have to deposit rupees 2 lakhs in his again rupees 1 lakh in his account, right? If it is 18, then I have to deposit rupees 2 lakh, and so on and so forth. So there is mark to market, right? Marking to market each day, so that the settlement happens at the end of the day. Futures are highly standardized and have deep liquidity in their markets and trade on exchange. So if I bought a future and I think that it's not a good instrument for me, I can trade it to somebody else who has higher risk appetite, right? So since it is tradable, so there is a value for the contract as well. So again, because they are highly tradable, I can have a opposite position as well on in the market, so that I can hedge my risks. Again, I have taken the example of Infosys stock. The same example is given here, right? So I have to deposit a margin money, and that margin money is again fixed by the exchange, right? So there could be a margin money, let's say 20% of the spot price or something like that of that future I have to deposit, and this margin money would help to mark the market, right? So this is again the same. The other important instrument is option, right? So it's a financial derivative that represents a contract sold by one party. So the party is called option writer to another party, which is option holder, right? The contract offers buyer the right, so offers the right, but no obligation, right? So that's the core difference. It offers buyer the right and not an obligation, right? In the previous case, forwards and future, both the parties, buyer as well as seller, were obliged to fulfill their contracts, right? But in this case, the buyer has a right and does not have obligation to do what is required in the contract, right? So what is the obligation? Either to buy, so buy is called call, or to sell a security or another financial instrument at agreed price. So agreed price is strike price during a certain period of time or a specific date, which is called exercise date, right? So for example, I buy an option, right? Buy a option that I want to buy Infosys stock on 30th November, right? On 30th November at a price, let's say at 2000 rupees. So this, and somebody is writing this call option for me. So this is a call option because I want to buy. So this is a call option, right? So now on 30th November, I have right either to exercise this option or not to exercise this option. I am not obliged to do so, but the writer of the option is obliged to do so in case I want to exercise this option. So as option, the name suggests, I have option, the buyer of the option has option to exercise the option or not. So since this is an option, I have to pay a premium to buy this. So there has to be a premium which I have to pay to the option writer, right? So that premium is something which I would lose if I don't exercise my option, right? And that premium is something which the option writer is interested in. He would gain that premium, right? So that's the difference between future and option. So call option gives that option to buy at a certain price so that the buyer would want the stock to go up. Put option, on the other hand, means that I want to sell the stocks, so that buyer would want to sell the stocks when they go down, right? For example, if I am sure that the stock of particular company would go down below, let's say 1800, right? I would do a put option with somebody and say that I want to sell the stocks of that particular company in future at a strike price of 1800, right? So that person would be obliged to buy stocks of that particular stock from me at 1800, whereas in market they would be available at 1700, right? So what I would do is essentially I would purchase them from the market at 1700 and I would then give it to my option writer at 1800, right? Though the physical transaction would not happen, right? I would the option writer would only transfer me the gains, right? There is no physical transaction which would happen, but this is how the logic should flow. So again, it is a highly standardized contract. They are traded on stock exchanges, right? Okay, and it would give buyer an option. So again, all this is mentioned. I think I have explained it, so we can skip. So strike price is important. It's an exercise price, right? Expiration date or expiry date again has to be mentioned on the contract. The settlement terms, for instance, whether the writer must deliver the actual asset or exercise, or may simply tender the equivalent cash. So this is also standardized in a way, right? So these are few things which are mentioned in an option contract, but since it is highly standardized, you would see that option contract vary from one stock market to another, right? So we'll look at various options, which is first is long call. So as we see that if I buy a long, right, if I have rights to buy, I am holding a long position, right? So let's say I buy a call, so I have to pay a premium, right? If I don't exercise the call option, this would be my loss. So this is the loss, right? Now let's say the price of the stock increases beyond the strike price. So this is the strike price, and price of the option increased beyond this strike price. So I would ask my call writer to buy stocks for me and I would gain the profits. So here the loss is limited whereas the profit is unlimited, right? The same thing is mentioned in it. So just read it. A trader who expects a stock price to increase can buy a call. So I expect that stock price would increase and buy a call option to purchase the stock at a fixed price. So I purchased a call option to buy the stock at a strike price at a later date rather than purchase the stock immediately. The cash outlay at the option is the premium. So I have to pay premium which is much lower than what is required for stock purchase, right? The trader would have no obligation to buy the stock and only has right to do so at the expiration day. The risk of the loss would be limited to the premium, unlike the possible loss had the stock been bought outrightly. So I am hedging my risk again here. So there are two types of options. One is American option. So we have seen that options are exercised on expiry date. American option gives you more flexibility as it is American. You can exercise your option on or before the expiry date, and there is European option where you have to exercise the option only on the expiry date. So that's the difference between American and European. In India there are both type of options which are available. So long put, I am the buyer of the put option and I have right to sell the stocks, right? So my expectation is the price would decrease and I would ask the put writer to buy from me at a higher price. So again my loss is limited to the premium, but my profits are unlimited, right? So just as the call option. So the only thing I am trying to say is for put writer the profits are unlimited. So for example, for the put buyer the profits are unlimited but the losses are limited. Exact opposite would be the case with the writers of these calls. So this is the writer of short call. Obviously if I gain he would lose, if I lose he would gain. So his gains are limited to the premium, his losses are unlimited. So he is a higher risk taker than a call buyer, right? So almost the same. Just see that you remember these graphs. There can be questions from these graphs directly. And finally the short put, right? The guy who is writing the put option for me. Almost the same thing. The last instrument which we would do, and which is the recent instrument, right, which has been introduced quite late, is swap. Swap means what? Swap means to exchange. So what can we exchange? We can exchange various financial instruments for mutual benefits. So most common types of swaps are currency swap, then there could be interest rate swap. So these are the most common swaps. Again, they are not traded on exchange, they are OTC and they are non-standardized. So since they are non-standardized, they are used very much, right? So two companies can enter into swap for the mutual benefit. We'll see it by an example. Again, the period is fixed, the amount is fixed as well. So let us take an example. For example, I am an Indian and I want to do business in US, right? But I don't have credit rating there. I'll get a loan at 7%. You on the other hand is American, your credit rating is good, you get loan at 4%, right? Similarly, you want to do business in India but you get 8% rate of interest and I am getting 5% rate of interest. So what would we do? We would fix a principal, right? Let's say X amount. We say that I'll borrow this X amount, which is equivalent to let's say which is let's say dollar equivalent of rupees, right? I would say that I would borrow these many dollars from Indian bank at 5%. You borrow these many dollars from US bank at 4%, and we would swap these two, right? The net resultant would be I would be getting money at 4%, you would be getting money at 5%, right? So both of us are better off than the previous scenario. So you would take loan for me, I would take loan for you, and we both agree to service each other's loan. So this is basic swap, right? Nothing more than that. So let's see how it actually happens. So this is an interest rate swap. So interest rate swap can happen from fixed to floating, right? So somebody is getting a fixed interest rate, somebody wants to do a floating interest rate, but conditions are such he is getting a favorable fixed interest rate from bank, other parties getting a favorable floating interest rate from the bank, so they would swap it. So here A is getting a floating rate of LIBOR. So LIBOR is an index which is very popularly used, plus 1.5, whereas B is getting a fixed interest rate of 8.5. Now A's business is such that he wants fixed interest rate, but he was getting quite high fixed interest rate. He was getting, let's say, 12% interest rate when he wants to get fixed interest rate from the bank, right? Similarly, B wants flexible interest rate, but he was getting LIBOR plus 1% when he asked the bank to give him a floating interest rate. So what would they do? They would agree. There would be a mitigator, let's say a bank, a merchant banker. A merchant banker would be there. He would mitigate or formalize a contract between both of these, and they would interchange their interest rate. So there would be a notional principle, right, which is same. So let's say they would say ki we would exchange the interest rate for 1 lakh USD, right? So whatever interest is incurred on 1 lakh USD, I would pay. Let's say if this guy wants a fixed one, he would get at this one, he would get a net fixed rate of 9.45 after the calculations, right? And this would get a net variable rate at LIBOR plus 0.55, whereas from bank he was getting LIBOR plus 1. So both of them are better off. So how would the trade work? He would say that there would be some agreement between them, right? Obviously he would not transfer 8.5 to this. He would say that I would transfer 8.65. Similarly, he would say that I would transfer LIBOR plus 0.7 to you, right? So these are the agreements which would happen between these two parties internally, but finally the outcome would be such that each of them is better off, right? So these are interest rate swaps. Currency swaps is again the same. Now because there is currency involved, whose rate of interest, whose value would also change as the foreign exchange changes. So the currency swap would include in case of interest rate swap, only interests were swapped, right? So if there was a differential in interest, that would be paid from one party to another, but in this both principal and interest is swapped, right? So that's the difference. Otherwise both the swaps work in the same way, right? So that is it about swaps, and this is how we would cover our derivative chapter. We are almost done with it. If you have any doubts, you can email us and we would try to answer your emails in 24 hours. So thanks for watching this video and all the best for your preparations.